done. Let's start. अरे मैं कौन हो गया? Hello everyone. Today I'd like to welcome you all on behalf of Bajaj Finance Limited for another exciting session. It is a continuous endeavor to empower our customers with knowledge of mutual funds. And to enable this, we invite leaders for mutual funds industry to come and share their expertise and knowledge with us. Today, we have with us Mr. Sailesh Raj Bhan, CIO, Equity Investments from Nippon India Mutual Fund. Sir, I'd like to welcome you for this session.
Thank you so much, Rohan, for having us and looking forward
Mr.
to
Sailesh, Mr. Sailesh has over 27 years of experience in Indian equity markets and has been with Nippon India Asset Management Limited with over 19 years. He is an MBA in finance and CFA by qualification. He has been managing multiple flagship funds, namely Nippon India Large Cap, Nippon India Multi Cap, and Nippon India Pharma for over 15 years. Today, in this session, we'll learn about building a diversified investment portfolio. Well, friends, are you familiar with the phrase, don't put all your eggs in one basket? And have you sometimes heard diversification of investments across asset classes is crucial to risk mitigation? I'm sure you must have heard the first one quite often, but not that much for about the second one. But let me tell you, both are saying the same thing. It simply means that you should avoid investing in one area or asset class so that one so that when one type of investment isn't performing well in certain market conditions, then the chance of losing all your investments is likely reduced. Well, we have a lot of asset classes: equity, bonds, debt funds, gold, real estate. And in today's session, we learn strategies for building a diversified portfolio across different asset classes. Well, without wasting much time, I'd like to hand over the stage to Mr. Sailesh Raj Bhan, who can help our investors make wiser investment decisions. Sir, you can please take it ahead from here.
Hi, good evening, and thank you for joining us today. Thank you for joining us today. Very interestingly, I think this is the most important topic which gets lost in euphoric and very, very exciting markets. When you see so much of returns being made in one asset class, most of the people let go the asset allocation framework or the principle. Over years, there has been research which has been conducted as always, and Ron, I'm sure you know that a lot of longer term returns are a function of right reasonable asset allocation and not just one single asset class returns. And I think a large part of investors in their journey, they start off with one asset class because they also accumulate wealth over time, but there is an appropriate time where you get yourself reasonably right asset allocated based on your risk profile. Let me give you a very simple example to this. uh, the beauty of where risk comes is very difficult for anybody to ascertain or anybody to really capture, right? And how much ever you try to predict, like for example, the most recent elements of risk, like when COVID came, there was a lot of difficulty in terms of understanding where it came, what degree it would impact, and all that. But if people were allocated across asset classes, the significant negative impact, at least for the initial period of a few months, which came on the equity side, would have been less painful for a lot of investors. And they would have stayed invested and retained their allocation and continued the journey if they had some exposure to other asset classes which wouldn't have fallen so much. So I think in extreme conditions, which actually repeat on a fairly recurring basis, I think a need for asset allocation is a must, and it's an asset allocation requirement for even reaching what your end objective is. For example, if someone requires money in the next 12 months and an event like COVID happens in the last 6 months of that period, the end objective cannot be met without doing the right stages of asset allocation. Another simple way of looking at this is if you look at you traveling from say Bombay to Pune, it's a 200-kilometer distance, right? If you wish to choose to be traveling at 50 kilometers an hour, which is a fair balance in terms of speed and risk, right? The chances that and you will reach Pune in about 4 hours. But if you wish to travel at 100 kilometers an hour, you could reach in 2 hours because it's just a 200-kilometer distance. But if you wish to travel at 200 kilometers an hour, right, you may not reach as well because that risk you carry. So the idea is our end objective is reaching Pune effectively, right? So end objective of any investor's financial journey is to create sustainable long-term wealth. It is not to create short-term wealth, which you end up losing without you end up losing when you really require to use it. So the financial journey has to manage both asset class selection and asset class allocation. And I think that is where you would find advisors and all helping you doing it. And I think as investors also, you should keep greater attention to it. Now let us look at many such phases which have happened. There are a lot of times when you see risk asset classes like equities can also correct 20, 30, 40% for reasons which are beyond one's control or reasons which are not entirely predictable. COVID was the most recent example which we have seen, right? And the emphasis is if you had a balance of non-correlated asset class where you would have invested in maybe a gold, maybe real estate, maybe somewhere else, I think your ability to handle the volatility is much better, and still you could meet your requirements during the period of COVID or during that difficult period by selling some asset classes rather than maybe possibly exiting equities at the wrong time. So the emphasis is very clear here. There are risks which we can control, which we do it when you do a portfolio construction, you do some diversification within the asset class. But at an investor level, at a whole wealth platform level, or at a level of your total wealth as an individual, the asset allocation plays an extremely, extremely important role. And I think it cannot be less emphasized. So let us look at what's happening today in the market. I just highlight a few important things because they really set the tone. Today, people are extremely bullish on the amount of foreign investment money coming to India. Today, people are extremely bullish on what is the outlook for India for the next 5 years. People talk about this being India's decade and all. So certainly, a lot of things are going right, but there are a lot of uncertainties which you can't see today, which emerge, especially when there is an euphoria. So euphoria is always punctured by some event, some large event which is there. So if you keep your asset allocation right and do maybe an annual adjustment to it or a 2-year adjustment to it, if there are very large variations, then your ability to reach your goal, which is the possibly the only objective of any financial journey. It's not making money is not the only objective of financial journey. The real objective of financial journey is to keep it attain the end goal which you want to, whether it is having capital for studies, having capital to buy a house, having savings for your retirement, having any such large goal to be achieved, right? I think that can only be met by using a combination of right asset selection and within that the right diversification, as Rohan talked to you about. So it may be least amount of research and emphasis has gone into this part of the aspect, but in our reading it accounts for a majority of your I would say end satisfaction or goal achievement which an individual can actually or an investor can actually achieve. Another interesting thing in my observation of the last 28 years of investing is that people have a lot of emotional challenges when they deal with single asset classes. For example, pure equities, when they are down 30-40%, how you behave is a true test of an investor. In a rising market, when people are writing comfortably checks on equities, that is not the behavior makeup where you can test an investor because that's easy to do, right? The real challenge for investor, a real challenge for an individual when they are allocating and looking at wealth is, can they take a 30-40% loss and still maintain the course of their financial plan? That I think is what determines the real long-term journey, and that can be achieved by having reasonable asset allocation and not, like Rohan said, putting all the eggs in one basket. And we have seen through and through cycles, right? You will have a lot of unexpected twists and turns. The only way to win the race is to be in the race, in extreme conditions, because you're not rightly asset allocated or you are leveraged, you end up exiting equity markets or other asset classes market at extremely long time and failing in achieving what you want to do, which is your financial, I would say, freedom or financial objective over the longer term. So I think asset allocation is a role which cannot be emphasized more. It is actually possibly the single most important tool an investor should keep at the back of their mind when they are taking decisions. And you can diversify based on many factors, but the primary factor for diversification is non-correlation between these asset classes and also the fact that there is the liquidity element in these asset classes, how different they are, and how much of part of your portfolio you want to keep liquid, how much of part of a portfolio you can hold on for a medium term, longer term period. I think matching this is the most important thing. Even if you look at banks, principally successful banks always manage their asset liability levels fairly consistently over long periods of time, don't carry mismatches. In that sense, an investor, based on his risk profile, should allocate appropriately their assets rather than getting focused on one single narrow vertical, because the volatility of that may not be appropriate for the investor at all points of time. So this is the construct from the importance of asset allocation. There are a lot of assets which are not correlated directly, which allow you to do this. There are interesting multi-asset category which is there, which allows investors to keep their portfolios fairly across international equities, domestic equities, into gold, into commodities, into debt. So I think there are enough and more options which have been built now, which have been created, and I think primarily each investor should look at his whole portfolio or overall wealth in the construct of how it is allocated from a risk reward and liquidity point of view, because I think both of these things will count in terms of the ability of the investor to carry on his financial plan and deploy money or stay invested in the financial plan which he has decided into and look when which he has decided into. We also do diversification within equity portfolios by investing across sectors, because that is one way we negate single specific sector risk, because sectors can go through different types of growth and weaknesses over time and can have cyclical impacts from global factors and local factors. And like we do in our equity portfolios, investors can continue to do broadly at their end, because that is the best way to give or achieve the, I would say, the risk adjusted returns which is there. Another way to look at asset allocation is it just allows you to take the right risk at reasonably right point of time. So obviously returns come only when you take a reasonable right amount of risk, and being well asset allocated allows you to allocate capital appropriately when there is a sharp decline in equity markets. Most investors don't have a additional cash to put in, right? And you miss out on that opportunity and actually end up redeeming at the point of time. So these things can be managed very well if you have a reasonably strong asset allocation framework created at your end, choosing asset allocation products as well, and also reviewing them periodically, which allows you to say that you are not kind of out of whack. Even within an asset class, a single asset class, there is a possibility of doing some asset allocation changes, because there are different risk curves for each of the products. Say, for example, large caps versus small caps, the degree of how much of what you own, I think it should be constructed based on your risk profile, how much you own of debt, how much you have of gold, how much you have of maybe even international equities, which are not directly correlated with India, for example. They have to be also be seen to be analyzed, and have a participation across, so that the real risk profile which you are trying to choose and which you are comfortable with, which will allow you to sleep well and take appropriate decisions in difficult times, is what this asset allocation framework or diversification framework provides you for. So this is what I just wanted to communicate on the diversification of portfolio and the asset allocation piece.
Thank you so much, sir, for all the insights. Uh, well, we have few questions lined up for you, and I'll go with them one by one. Sir, like in today's scenario, we have headlines, indices like Nifty 50, Sensex have hit all-time high, and it is the talk of the town. There is a lot of noise associated with these events, and at the same time, this could be a major deterrent to prudent investors. What is your advice in this current market situation, and how could you go about creating an ideal investment portfolio?
Yeah. So it's a very interesting and a very topical question, because this is something which is there in everybody's, I would say, top of the mind recall to, the challenge here comes when you are not approaching your investment as per a financial or an investment plan. If somebody is doing the investment on an ad hoc basis, markets have risen and now I want to invest. That is a different kind of a risk which he's willing to take, right? Because he's not doing it as per plan. So the logic here for us is to see that when you are doing investing, one is the market level, which does matter, but the time horizon matters equally more or even more in this case. So if you have 3 year, 5 year capital, attempting to time markets, unless these are extreme markets, is a challenge. These are reasonably okay markets. From a 2 year point of view, markets have been flattish. Equity markets have been plus or minus 5%, right? Or 7%, because Nifty was, I think, at the peak 18,700 somewhere in September, October 2021. Now it's nearly 2 years that we are plus or minus 5-7% from there. So, in terms of the construct, you will always find news flows not allowing you to take a right decision. And if that is allocated appropriately, like if you have a time frame of 3-5 years, this is not a very difficult time to invest in. And if you have return expectations which are moderate after the rally, this is not a time to stay away from. Second, within that, you can sub-segment a bit. Fine, we are finding froth in, say, mini cap companies or very small size businesses. Greater participation there, and you can have greater participation in the large cap space versus, say, the mid and small cap space, because you may have a fee. The other piece, yeah, the other piece in terms of the current market construct is how much should as PV or an important decision for investors to take. I think what one should file or asset allocation plan you have created. If you have said you want to keep between 30 to 50% equities for the next 5-7 years, just stick to it. And unless those change dramatically, that you go 10% higher, if 50 has become 60, then you recorrect. But within a range, stay invested in the course. I have not come across anybody who times market perfectly. And this is in 28 years. I've met every single person who has attempted to do this and have not come out with anybody timing it right, and at least not timing it right twice or thrice. Timing it once is luck. Doing it repeatedly is not there. So just stay course to the plan, participate in equities from at least a 3-5 year horizon, and keep the allocation within the financial range to from there. His video or video? Hmm?
Yes, sir. I have another question for you. We are seeing a rise in index funds. And what is your view when we are trying to compare index funds with active funds, and how can they become the part of the
Yes,
investor's
Rohan.
portfolio? Hello. Sir, can I repeat my question?
Yeah. So yes, yeah. Please do. You're talking about active funds versus passive funds, right?
Right, sir. Right, sir. So I have a question. So what is your view with respect to active funds versus index funds? There we have seen a recent rise in uh, index funds. What are your views, and how what would you recommend? How it could become how could index funds become a part of integral part of investors' portfolio? And also, is it ideal for first time investors?
Yeah. So it's again a very topical and current debate, because that is what is a lot of discussion around this point, and it's very important to work on this. So two things: both active as well as passive have their respective roles to play. So index fund, what does it do? It allows you for participation in Indian equity markets in a simplified manner. So it has a role to play, and it's important in your asset allocation to have participation in passive funds as well, right? So there is no debate about it. It allows you, whatever market returns come, it allows you to mirror and capture most of it, and it is in a way. An investor has a 5, 10, 15-year plan. The whole India growth can be captured through investing in some of these indices, and they can attempt to do that. So that gives you the beta of the market, as we call it. The second aspect where active funds come into play is also interesting. So if an investor wants 50% of their return to be linked to what the Indian equity markets deliver, they can put that money into index funds and things like that. But some proportion of that goes into active funds, because there you expect that an opportunity to create material alpha exists in Indian equity markets. So I'll give you the second aspect to the active side. On the active side, if you look at it, in India, many sectors are still very young and have very little representation in indices. Right, so large sectors like manufacturing and engineering have actually maybe 3% representation in India's index. Right, many large sectors, insurance and all, are very small representation of them in their weights in the indexes. So participation capture value which lies outside the index in a diverse large country like India, where many young sectors are being born. Active funds have that role to play as well. So I think for an investor, he just wants beta of the market. Index funds are the best simple play available. And those who want to participate additionally, in addition to the beta, want to take a additional risk for the long term returns, the new sectors and differentiated sectors can provide, and the fundamental skills can provide. Should choose to participate in active strategies. So both have relevance based on the end objective of the investor and have a material meaningful role to play in how he defines his asset allocation over the longer term.
Okay, sir. Well, I have another question for you. There are a lot of questions that we have for you today. And the other one is that how should our customers go about, regularly reviewing their portfolios, and what could be the effective rebalancing strategies so that they can implement? Hello, hello.
Yeah. Shall I
Sir,
start?
should I repeat the
Go ahead with
question?
your question. Yeah.
Hello, sir, should I repeat the question? Hello. Sir, hello. Can you hear me?
Yeah, Rohan, can you question? Yeah. Yeah.
Yes, sir. So I have another question for you. We have a lot of questions
Yes,
for
Rohan.
you.
Yeah.
And the other one is that how should our customers
Yes.
go about regularly reviewing their portfolios, and what could be effective rebalancing strategies which they can implement?
Yeah. It's a very important question. What is important in rebalancing is designing your financial plan with some flexibility, keeping a range for each asset class. Like I mentioned, you can divide your portfolio into equity, so you can keep a range. And when these lower range and higher ranges get breached, like 30% and 50% breach, you can do a reallocation. You can review portfolios once a year, but real reallocation can happen only when these larger bands which you create for yourself change. Cross, say, 50%, which is the risk profile which you want to achieve, right? There is a possibility you can also book profits at that, and keep a and shift to gold or shift to the risk which is there. So clearly, within a band and the framework as decided by your portfolio or financial you can move around between a range for each of these. Don't keep one finite number for a asset class. Keep a range for every asset class in your financial plan, so that your long-term risk profile doesn't change. You meet your end objective, and you are still within that you still benefit from tweaking your portfolio maybe annually or on a 6 monthly, annually or a biannual basis.
Okay, sir. Well, I have another question for you. Uh, well, ask. So, there different customers have different risk profile, and how should our customers go about assessing the right uh, risk to the right portfolio mix that they have? What could be the ideal time horizon uh, through which they can benefit for a given portfolio, and for how they can have an ideal portfolio which will have impact and help them create wealth for themselves. Hello.
Yeah, Rohan, can you repeat the question? Was you had some break in the
Yes,
voice?
sir. Yes, sir. I also had some break over here in between. Well, sir, what could be? So we just wanted to understand from you, how could the investor go about choosing the right portfolio mix according to their risk appetite, and what could be the ideal time horizon to see the impact of the created portfolio? Hello, hello, sir. I think hello, sir.
Yeah.
Sir, can you hear me, sir?
So, Rohan, as I understood your question, you are referring to the how to reach it, right? Yeah. So, yeah. So, what is interesting here when you do this kind of allocation is the first important thing to keep in mind is what is your risk appetite. So if you look at equity as itself as an asset class, and within that you wish to do a little bit of diversification, how do you approach it? For example, India's market to 70% are large caps and about 30% are mid and small cap companies by market capitalization of the country, right? If you are an average investor with an average risk profile and you're not very aggressive or very conservative, I think you can move with what the risk profile which is offered with the market, and you have maybe 60-70% invested in large cap and about 30-40% invested with stay the course with that over a period of time. If you're a very aggressive investor, you can even have a reverse stand which says you have 30-40% in large cap and 60-70% in mid and small cap. But that time horizon of that portfolio and the way you look and evaluate it should be rolling 3 years, 5 years, 7 years, and cannot be very short termish, because lot of stocks in mid and small cap companies require that 3-5 years to deliver, and cycles, ups and down cycles, are also fairly large in the lower market capitalized businesses. So an investor can choose, primarily decide what type of risk he can take, and accordingly have his allocation like within equities like this, and also how much of non-equity portions, which is debt, which is gold, he wishes to own. Another way of addressing this is, if you look at the challenge coming from the loss aversion which all investors or every individual has. For example, if you decide that you cannot afford to lose 10-20% of that, if you decide that you cannot afford to lose 10-20% of that, then your allocation should be appropriately lower in equities and higher on the other asset classes. So primarily the starting point, the best starting point is, what is your loss taking ability and what time frame this capital is. If these two questions are written down in a piece of paper, an investor can be able to define his risk ability and do it. Suppose an investor cannot afford to lose 10-20% of that, then your allocation should be appropriately can afford to lose 20% of his equity portfolio and still be able to be flattish for a year, then he can and wants it to have at least minimum zero returns on an overall basis to the portfolio on a worst case basis, then his exposure to equity should be much lesser. And if he can take much higher risk and can even have a negative year or two in his investment plan, then he can have a higher allocation to equities within that. So it's not something that you want to see a loss of. And how long you can hold money to, I think these 2 points will answer.
Sure, sir. We have one last question for you, uh, and it is very important. Hello. Uh, Sorry, audience. I guess we have few technical issues going on. Please bear with us. We are fixing it.
Hello, you're on.
Hello, sir. We are back. Hello. So I have one last question for you. I hope you can hear me. Hmm.
Yes, Rohan.
Sorry, audience. We have few technical issues going on. I guess there's an internet issue going on. Sir, can you hear me? Hello, sir.
Yes, Rohan. Yeah.
Yes, sir. So I have one last question for you, before which we can close down. Uh, so, what are the main pitfalls which our customers and investors should avoid while approaching diversification of their portfolio? Sir, you're on mute. Sir, you're on mute.
The question is primarily that is over
Now
diversification
it's
is a
fine.
challenge, right? Yeah. So the question is more to say, are you over diversified, which impacts your returns negatively, right? See, it's I think it's a fundamental question where if you over diversify, you become the market itself. So you cannot expect to get differentiated or higher returns than that, right? And you may lower the risk in the sense the volatility of what you construct, but it may not at the end of the day serve the objective where you're trying to meet your longer term return gain or longer term return target. Now, excessive diversification is a big challenge, and I've seen investors running portfolios of 300 stocks, 400 stocks, and all that. Even smaller portfolios being run like that, and even within asset classes, when people try to diversify, the element of diversification coming from liquid wealth, illiquid wealth is also not managed. For example, we find a lot of investors having 80-90% of their investment in real estate, right, where their ability to take out money from that on a in the case of some emergency or something is fairly limited. And hence, either you decide that you keep an x level of liquidity, always say, you say about 50% is liquid medium term investments which you require, and 50% is illiquid 5-year 10-year horizon products, and then manage it. But putting money at all points of time and without having that band where, a range or a band in which you want to participate in different asset classes, will create a challenge and lead to extreme diversification. For example, if you say for equities you have a range of 30 to 50%, for debt you have a range of 20 to 30%, for gold you have a range of 10 to 20%. If you don't keep this framework, and instead of having 3 4 asset classes, you end up getting into every other category, right? Then it creates over diversification, difficult to manage, and very difficult to time the output or the outcomes which come. So two or three asset classes are enough to allow for the right diversification which you wish to get. And I think one should just look at three, maybe maximum four asset classes to have a diversified experience. If you go beyond that, there is just no extra additional benefit of diversification which comes to investors, and it starts hurting your returns significantly.
Well, sir, I'd like to wrap up the session now. I'd like to thank our audience for joining us today. We certainly learned main strategies of how to build a diversified portfolio. We are confident that this session will help our investors make more informed decisions to achieve their financial goals. I would request all our viewers to please share their questions in the comment section below, and our team of experts will answer all the queries. Before closing, sir, I would request you if you could share a few points and end the session, sir.
Yeah. So thank you so much, Rohan, for having us on the program, and thank you for giving us an opportunity to connect. I just want one or two points to be as key points or messages which can remain with all of us. Because first is, um, don't consider diversification as a dilution of your returns, because at the end of the day, the most important objective for an investor is to reach his end goal, not be successful in the interim, and not reach the end goal, which is possibly the primary objective. For example, the Bombay Pune example which I gave you, the most important thing is to reach Pune in reasonable right point of time. So if you reach in 30 minutes or reach in 1 hour, it doesn't change the whole course. But most important thing is you have to reach there. So you can't take the risk of not having right diversification or right risk management, which the diversification or asset allocation really provides. And you have to use that as a platform to be able to build your long-term wealth creation journey. So with these, I would like to personally thank Rohan, and thank you viewers for joining in today, and wish you the very best in your financial journey. Thank you. Thank you, Rohan. Yeah.
Thank you, everyone. Thank you so much, sir. We'll be looking forward to conduct more sessions with Nippon Mutual Fund. And thank you, sir. Thank you.
Thank you so much, and wish you the very best.